The review by Sapasa Dasgupta provides vital stimulus and insights that I hope will lead to changed perceptions and, in turn, redoubled efforts for the recovery of nature. Indeed, the restoration.
Let me very briefly stop here, because I think for the intro that's sufficient. And then at least I want to move a little bit ahead. He's talking for quite some while. I have another gentleman actually, whom
We've been aware of the damage humanity does to nature. There have been those who say we simply can't afford not to do that damage. And they say that the global economy and the natural world are at the opposite ends of a seesaw, and for one to go up, the other must inevitably decline. Well, I'm very pleased to say that with this report, Professor Sapasa Dasgupta has well and truly knocked that myth on the head. He shows that far from existing in opposition, the economy and our ecology are in fact inseparably intertwined, two atoms in the same molecule. And he proves to us that going green actually creates more jobs. And that's exactly why we in the UK are determined not only to build back better from COVID, but build back greener as well. It is a comprehensive and persuasive text. But even at more than 600 pages, it represents only the first chapter of this story. Because today, Professor Dasgupta passes the baton to us, politicians, policymakers, business leaders, and civil society. He's shown why change must happen. And now it's up to us to bring that change about. I'm proud to say that the UK is already doing so, committing £3 billion of climate financing to support nature, for example, and spearheading the global leaders' pledge for nature. And that is exactly the kind of action we'd really like to see other nations joining us in taking. Because biodiversity is not just a nice to have element of long-term economic growth, it's essential to it. It's an intrinsic part of that growth. And that's what Professor Dasgupta's report is all about. I can't thank him and his team enough for putting it together. And it's a body of work that I'm sure the world will come back to time and again as we engage in the vital work of protecting, restoring, and improving biodiversity.
Us now having the chance to at least understand whom these gentlemen had been talking about, let's actually give that man also for a second the chance to say something by himself. And I'm just forwarding that likely to the more interesting parts here. Let me get started here, please.
It makes sense to focus on the accumulation of produced capital, that is roads, buildings, ports, machines, and human capital, health and education. Unfortunately, the resulting macroeconomic models of growth and development so directed the way academic economists and economic policymakers collect and analyze data, forecast trajectories, design policy, and conceive our economic possibilities, that we have over time come to imagine that we can bypass nature in our economic lives. That belief has been strengthened by the fact that the average person today enjoys a far higher income, is less likely to be in absolute poverty, and lives significantly longer than she did even 70 years ago. The world economy has grown 15-fold since then. So it would seem we are living in the very best of times. But nature is an asset. We are embedded in nature. It is our home. And it provides us with a multitude of services we take for granted, such as regulating climate, cleansing our water, decomposing our waste, and fixing nitrogen. But even while we have enjoyed the fruits of economic growth, the demand we have made of nature's goods and services has for some decades exceeded her ability to supply them on a sustainable basis. Because the difference between demand and sustainable supply is met by a diminution of nature, the gap has been increasing.
No, much better. Sorry for that. But in the UK, actually, they have commissioned a couple of years ago this gentleman, Mr. Dasgupta, to put together a review on some kind of more broader sense. And I'm going to share some high-level views on that in a minute, on that report, because I think it's a nice read. So that report exists in a couple of different versions. It's a kind of more 10-page overview version, which is only for the people who don't have time to read through. Then there is a kind of lengthy version of 600 pages with a lot of formulas and a lot of details, which I also do not recommend to read. But there is an in-between version, which they call the abridged version, which is, I think, a rather nice read in that respect here. Because right at the beginning, we started with a discussion about economics in general. And I introduced some views from Adam Smith, who more or less introduced the kind of key parameters we are using also for our discussions here, which is risk, which is return, which is the supply and demand. But that actually, I said at that point in time, was limiting or was based on the limited views these people had at that point in time. Remember, the underlying assumption at that point in time was, if there is something missing, you just need to leverage a little bit of capital, and then actually you just can get the kind of missing resources by implementing capital or deploying capital out from nature. Now that view to some extent is outdated, and Dasgupta did a very intensive economic review with nowadays understanding how nature has to be integrated into the overall economic view in order to form some kind of more modern view of economy in general. And as said, I've uploaded this material. It's not recommended to go through the entire full version, but you potentially ultimately may have, at least at some point in time, if being interested, a read of the abridged version. Now, the traditional view on economy always is you have some kind of capital which you need to deploy. And that is actually the kind of initial way of looking at it. And at some point in time, people added at least the human capital to the equation, meaning that there is, of course, also some need to consider that people ultimately get education, that people have health improvements, and that is forming then also part of the entire global economic description. Now, nature is an element part of the entire view, of course, as well, and for one very specific reason, and that is in our existing or in our so far deployed economic underlying theory, we always assumed that product capital, human capital, can grow at least limitless. Yeah, so there are no boundaries. We at least can grow our economy without any kind of limit. Now, if you put at least nature capital into the equation, and that is what Das Gupta then also shows in this report, is that there are certain limits existing. And if you consider the nature as a source of capital as well, then you do, of course, understand that the growth on the product side or on the production side, on the human capital side, which we have seen over the past decades and centuries, was more or less built upon a depletion of resources on nature on the other side. It looks a little bit simple, and everybody easily would agree to these kind of statements, and everyone would say that's of course quite clear. We are using natural resources, and then actually we are growing our economy on top of that. Now, he does that on a kind of very rigorous and very scientific and academic basis. And shows that at least the growth in product in production, the growth in wealth on the earth over the past couple of decades and centuries was more or less based on the depletion of resources on nature on the other side. And this is, as he outlined it, is not sustainable in the long run, because our nature capital is limited. We are living on this small small sphere. At some point in time, the resources, if we are using them not in a sustainable way, are depleted, and then actually there is nothing left over. Now, rather than using my simple words, how he actually outlined these kind of ideas, as said, I recommend for the ones being interested in having a look at. The UK sometimes being blamed a little bit for not being at least at the forefront of certain developments, have initiated this kind of program, and it worked a little bit different also as compared to some other countries. There the finance minister just ultimately goes out and ultimately appoints more or less the person who is most capable doing that, and then he more or less orders everyone else to support him. In our more federal country here in Germany, it's likely not going to work that way. It's a good way to at least see that also academic progress could be initiated by politics. As that, it's at least something I recommend for reading. And as you can see, it's when you go to the abridged version, it's more easy digestible. If you really want to do the hard stuff, there is a very thick paper existing with a lot of fundamentals as well. This is the extension a little bit of our underlying economic theory, which I'm for the time being not touching more in detail. It's more giving you a little bit of inspiration to look beyond the more traditional approaches to investing. Now, as I understood that by last time I gave you some kind of idea about our first theory, I at least want to spend a few minutes right at the beginning about recapping some of the elements before we move one step ahead. Remember where we are, and that's what we are going to do by today. We are talking about, so to speak, the first theory at hand in order to describe investing. That was the CAPM, and I'm going to revisit that in a minute. But then, of course, we do want to understand how to implement that. We are not going to do that by today, but more likely by next time. We need to lay some kind of more foundations, but I'm going to introduce here very concretely certain of these instruments which are necessary in order to implement a passive investment strategy. Yeah, so we have at least now some theoretic understanding that passive investing is good. There is a market portfolio. We will come back to that in a second. And that's what you should buy and do nothing else. The question is how. And this how is now forming the part of today's and next time's discussion, that I'm going to give you more ideas about how to invest passively. Now let's briefly go through that theory, just for the simple reason it's a very fundamental concept. You should ideally have a kind of good understanding how it works. Hopefully I'm going to repeat everything which is already very present with you, but let me give it at least a few minutes in order to make it again a little bit more clear. We are talking about risk and returns. These are the essential parameters. Now let's forget a little bit about the intro I've shared with you a minute before, but risk and return are for our investing the essential parameters to describe any investment. And of course, we are typically not backward looking, but we are forward looking. And when we are forward looking, we are interested not in some kind of historic returns. We are only interested in the expected return. Now, the theory makes the assumption that people have rather homogeneous views on expected returns and on expected risks. That is what the theory requires here. But given that, we easily ultimately now can look to very different risky assets out there, and these risky assets then have a risk and a return characteristic. So, so to speak, it's somewhere here. It has a risk and an expected return. And we can easily ultimately plot all our risky assets into that kind of graphical overview. Now, when I distribute my wealth amongst different risky assets, the return always will be the sum of the individual risky assets. Yeah, so I put some money into the first risky asset and put some money in the second risky asset and in the third and so on. The weighted sum of the returns is finally the weighted return I will achieve from my entire investments. Yeah, so the return is, so to speak, linear. I put it into different assets and just the aggregate sum is what I will get. Now, this is not true for the risk. Yeah? And for the risk, we have introduced this more simple concept of standard deviation of historical returns that gives you some understanding. The risk is quadratic. So it's not that I'm adding up the risk of my risky assets. It's not that I'm adding up the risk of my first asset and the second asset and the third asset. That is not my entire risk. Yeah? The entire risk is governed by diversification. And because of that, we are able to combine different risky assets and end up with a more optimal solution, but rather than ultimately investing into one single asset only. Yeah? So diversification allows us, and that is the general approach you're going to take here, to have some expected or some aspired return, and for that return you then can ultimately vary the kind of different assets in such a way that you obtain the minimum risk. And when you do that for all the kind of different returns, you obtain this efficient frontier, or this Markowitz efficient frontier, and it's sitting somewhere typically on top of my risky assets. And this is really the more underlying essential assumption here. My risk is not just additive, but diversification. So the non-perfect co-movement of my assets is going to lead to the fact that the total risk could be lower than just the simple sum of the risks of the assets I'm going to invest into. So I have 10 different stocks. I'm not just adding up the risk of these different stocks, but due to the correlation of these stocks, my total risk is smaller. Now, the approach I usually need to take is that I'm going to calculate my return for a very specific combination of my assets. And then actually I need to calculate my risk considering the correlations. Now, usually I do it the other way around. I fix a return which I want to achieve. And then on the other side, I minimize my risk. That is, I'm going to vary the weights of my different stocks in such a way that I obtain a minimum risk. So this is the typical approach I'm going to take here. Now, we introduced one more concept, and that was the concept of a risk-free asset. And when I have a risk-free asset, it has no risk, but it has a certain return. And then I'm able to combine my risk-free asset with my risky assets. I introduced, in addition, the concept of the preference lines, and you may remember that I, as an investor, I'm a rational investor. That means I do want to have more return for more risk. Now, I'm also risk averse. That means the higher my risk is, the more return I want. And I not only want a linear way of more return, but my risk averseness is going to let this curve increase more steeply. That is, at a certain level of risk, if you want to take me more risk, then I want to have exceptionally more return. So my risk appetite is decreasing dramatically beyond a certain threshold. When there is really no risk, I'm more or less relaxed, and I'm more or less easy about that. Now, these preference lines combined with the efficient frontier and the risk-free asset led to what I was calling the capital market line. That is the line which is touching the efficient frontier at one point. And that specific point was the market portfolio. And I justified the market portfolio as such that I said, this is now here from the easy graphical representation, it is the best portfolio you can get as an investor. There is no better portfolio you can get. Very simple. As I do have my preference lines are upward sloping. They touch at least this capital market line at one specific point. And the capital market line is a combination of my risk-free asset and the market portfolio. So everyone out there holds either a fraction of the risk-free asset or of the market portfolio. And if everyone holds exactly the same portfolio out there, this must be the portfolio of all risky assets. So that is the market portfolio. Everyone holds a fraction of the same portfolio. If everyone holds the fraction of the same portfolio, all people together hold exactly the market portfolio. That is the sum of all risky assets. That means ultimately the price of the risky assets times the number of units of that risky assets which are available. So this was the very simple theory giving an answer to the question, what should I buy? So I have some money, I do want to buy something, I do want to invest some money. The question was, what should I buy? This theory gives you an answer. You buy, because you are a rational investor, the market portfolio and nothing else. Now, obviously, in reality, not everybody does that. And we are going to face at some point in time the situation to discuss more in detail what's going to happen if people are not doing that. But in order to start a little bit smoothly, this is now our first answer. Now there is already one simple consequence. And I don't want to hide that consequence from you. Now that's the same with a little bit less graphical freedom from our capabilities from my end. Now, this is something we are going to revisit at some point in time. Yeah, we are going to have a look at that later on when we are talking about exclusions again. But I'm going to share with you what you are going to see here. You're going to see here two different ways of investing. One is with a certain industry group, and one is without that industry group. The investment which is here excluded is tobacco. And some people did a 100-year study about what would happen if I'm going to exclude tobacco. Now, from our theoretical discussion, we already know one answer, and the answer is it's suboptimal. If I'm crossing out certain of my risky assets, I will end up with a less optimal efficient frontier. So in consequence, I will have a lower or a higher risk or a lower return as I could achieve when I would include tobacco. Now, the study reveals that if you are going to exclude tobacco, you are worse off. Yeah? Very simple. Now, maybe not from a moral point of view. From a moral point of view, you may feel better. But if you really consider only the parameters risk and return in the long run, you should have invested into tobacco. For the past 100 years, it's true. And that study was done for the US, it was done for the UK. And it'll at least give us now an indication that our theory potentially is giving us at least some hint into the right direction. If we exclude something, we end up with lower return. Yeah? And that is something certain of the institutional investors I was introducing a little bit earlier in our discussions here. Some of these institutional investors do know. Yeah? So the Norwegian pension fund says very clearly that they have lost money. Yeah? So they indicated that they have lost about whatever they call $2 billion of profit because they haven't invested into tobacco. Now, if you remember, they had $1 trillion of assets. So these 2 billion are not necessarily a lot of money, but at least for the individual, 2 billion euros are or US dollar are a significant portion of money. Yeah. And other institutional investors also came up with similar statements. If you pull out of certain industries, you potentially lose money. Yeah? And that is something we always should keep in mind. We can now explain that easily with our theory here. And that's why I was revisiting this, this theoretical approach. If you go back here to our overview, if you do not consider some of those risky assets here, the efficient frontier is likely a little bit lower. As the efficient frontier is a little bit lower, the capital market line is lower. As the capital market line is lower, the return you put, the market portfolio or the portfolio you can invest into is giving you lower return for the same amount of risk. Yeah? Or higher risk for the same amount of return. Now, this is what we can explain now with this theory. Any questions so far? Because then at least we will stop with this theory stuff and move ahead and discuss how to implement that in detail. Questions, comments? Does anyone at least do not believe in this theory? So then I will have a hard time when I'm going to introduce next time, or when I'm going to introduce the next theory contradicting it a little bit. Now, in order to implement active passive investing, the underlying instrument you potentially would need is the market portfolio. Now, the market portfolio often is represented by indices, and likely I've made a mistake and put into the notes the answer to my question here already. So this question addresses only the ones of you who have not had a look at the answer. So anyone who had not yet a look at the answer can give me an idea about how many of those capital market indices you potentially would assume. So in theory, there is only one market portfolio. In practice, at least, you have heard about the Dow Jones Industrial Average, the DAX, the S&P 500, maybe about some other indices as well. So any ideas how many of those indices are out there? Everybody has looked already at the answer, huh? Someone who hasn't looked at the answer and has an idea. $200? Okay, so we have 200 ultimately. Yeah, so it's a little bit like an auction here. Yeah, somebody ultimately want to come up with a different figure. We have 10,000, so the gap is widening. Yeah, so we have anywhere 210,000. A third answer. No third answer. Now let's see ultimately where the clock is stopping. Can get started ultimately. So you know a few. Definitely, I think my number is already increasing far beyond your 10,000. And I'm going to need to justify in a minute a little bit my answer here. I'm not entirely sure if somebody really has counted all these indices in very great detail. But the Index Industry Association assumes that there are more than 3 million indices existing. Now, given that we at least have one market portfolio and 3 million indices, that would require a little bit of an explanation. Yes, please. Yeah, so when digging out these numbers, you usually go to certain institutions or to certain organizations who are pulling together these figures. That figure actually is pulled together, as I said, by the Index Industry Association, and the large index providers all form part of that index association. Now, obviously, there are other people who are also calculating indices. And I'm going to give you in a minute some answers or some more rigid examples about those organizations. Likely there are even more out there available. it's an enormous amount of indices, and likely we need to answer a little bit the question why that is the case. So why are there so many indices? Yeah. It's maybe not the question how many exist, but it's more the question why there are so many. Now, before doing that, and before giving you an answer to that question, let's have a little bit of look to some of the more well-known indices, and try to make you a little bit more familiar with what they are really measuring. That was well managed. This is the Dow Jones Industrial Average. It's likely the oldest index. It's going to become 125 or so in a few months or so, and within the next year. And obviously, if you look to that chart, you'll see that that index has shown a dramatic increase throughout the years. Yeah, so it's growing tremendously. Yeah, so it, from an investment point of view, it looks like a kind of very nice investment. Yeah? So in putting some money at the beginning in whatever 1896 into that index, you would have ended up now with some 30,000 right now. And people easily ultimately say, well, the Dow Jones will be 100,000 in a few years' time. And if I'm going to look at that, it's not necessarily too astonishing that I'm going to come up with that answer. Apologies. I may come up ultimately with a little bit of a kind of different view to the same index, and that potentially is going to help us a little bit better already to understand what these indices are measuring. But I'm not going to plot the index as before in a kind of ordinary way, but if I'm going to plot the index in a more logarithmic way, you can see that more or less it seemed that the index is going to grow more or less at a constant rate. And you may remember some of your whatever intro lessons or some math lessons a little bit or less math lessons in school. If you have a linear line in a log plot, it's going to indicate that there is a constant growth rate existing. So if the growth rate is constant, then you have an exponential growth in real terms. On a log plot, you have a linear line. That's the stuff ultimately we have been talking about throughout the entire COVID pandemic. If there is an exponential growth happening at some point in time, the growth rate at least has a certain, it is constant. Yeah? And the growth rate of the Dow Jones Industrial Average is whatever, 7% or so, yeah, 6 to 8%, depends a little bit on what time frame you're looking at. And this gives us a very good idea what I will get if at some point in time I'm going to invest into that market or into that index. I will get 6% per annum return. Yeah? And we will see that, or we will meet this number a little bit later or throughout the course again and again. Yeah? That means if you invest into large US equities, your return will be 6% on average. Yeah? That's at least an interesting learning we are going to take out of that chart here. And it looks at least rather stable throughout a very long period. Yeah? So we are starting in 1896 and we are ending whatever now in 2022. And we get 6% per annum. That's great. Now we see already a few more things here. I need to try that again. We see a few more things here. We see, obviously, there have been certain crises happening over the past decades. And some of them you may know, yeah, some of them you may not have heard about. There was some global financial crisis. There was a burst of the tech bubble in 2000. Now, actually, what really ultimately becomes very obvious on that scale here is that this kind of big financial crisis in the US in the 1920s has created the kind of largest downturn in real levels, at least on that scale here. Yeah, so given ultimately that, of course, the index was going to increase throughout time, the downturn which happened in the Great Depression in the 1920s in the US was significantly larger than anything else which happened thereafter. And it may look a little bit cynical, but the recent events happening in the Ukraine are actually not going to have any impact on that scale at all. So certain of the global crises which we potentially sometimes perceive important or also stunning are not necessarily going to have a kind of rather decent long-term impact. Now, this is what I'm going to talk to you today about. We are going to talk about the kind of financial instruments which are the ones you really can buy and invest into, or the ones also institutional investors are buying and investing into next time. For today, we are going to talk about the basics for that. And the basics for that is I do need to introduce to you a little bit more the concept of indices. That's what we are going to do by today. And I'm going to give you some background on the industry. I'm going to share with you a little bit more why there are 3 million indices out there. And then in addition, I'm going to make you understand how an index is being calculated. It looks a little bit complicated, but it's the underlying basic idea is rather simple. And that is what I want to share with you by today. Now, at the end, we are going to have a look into one very concrete and specific example. And the concrete specific example is we're going to have a look to the DAX ESG 50. It's a newly created index concentrating on German stocks, claiming to have a focus on ESG. And with our knowledge about how indices do work, with our understanding, we are then going to assess that index a little bit later by today. So that's my agenda. All right. Now, indices are being used for a couple of different purposes out there. Yeah? The most important purpose, of course, is information. If you want to know ultimately if the markets are going up and down, you're not going to screen through 100 different stocks and ultimately get some kind of basic gut feeling if the market is now going up or down, but you're looking at an index. People are talking the market is going up because they actually say the Dow Jones is going up, or the S&P 500 is going up, or the DAX is going up. So it's a very fast and efficient information tool in order to make you understand what's happening overall. Now, in addition, people are using it as a kind of yardstick for the performance measurement of their investment. If you tell me that you are investing into US equities and that you are doing a great job, how should I know? You tell me ultimately you generated throughout the last year 11.5% return, and I have not a very good understanding if that's a lot or whether that's superior or worse. I have not a great idea. I need to have some kind of yardstick to compare with, and that's why I'm using indices as well. So if you say you're investing into the US market, generating a return of 11.7%, but the US market the Nasdaq last year ultimately increased by 25%, I would say ultimately, yeah, maybe ultimately your 11.7% are nice, but it's not going to convince me that you are a great investment manager, because unfortunately, if I would just have bought the Nasdaq, I would have been better off. So it's giving me an idea how good or bad people doing investing. And then there is a last purpose of indices, and that's the primary reason for what we are going to talk today about is indices are being used as a basis for financial products. And when I want to invest into a market, I do typically need to define that market. I define that market typically by an index, which I'm going to use, and then I'm going to invest into that index. All these kind of different use cases for indices require a certain amount of different methodological fine-tunings, and we are going to come back to some of these requirements in a minute. Now, in order to justify a little bit why indices had become so important and why there are so many indices out there, people are investing more and more money passively. So they invest money into indices. And I share that already. People invest more money into passive funds compared to active funds. So it seemed to be a large business. And in order ultimately to justify that even more, the business is not only large, it's also growing dramatically. And I put up here a few of those global index providers, and they make a ton of money out of those indices. So anyone who has an idea. Now the two things to mention. So ultimately the industry is growing very fast. That's always good. But it's not only growing very fast, the industry has in addition also one feature which is outstanding, and that is the profitability of that industry is so high. And if you have an industry where the profitability is anywhere around 50%, that means for every US dollar, for every euro you earn, you get on the other side 50% or 50 cents as return. So you earn a euro, you have costs of 50 cents, and then at least 50 cents stay with you. That's a kind of great business model. If you sell a car, you sell the car for 10,000 euros or US dollar, and you are lucky ultimately if there is whatever 500 euros left over for you. So the profit margin for car makers is significantly lower. The profit margin in many industries is significantly lower. Would anyone, or does anyone have an idea why that profit margin is so high? So if you want to open up a business at some point in time, go for a business which makes that much money. It's going to make you rich. But why is that the case here? Right, that is part of the answer. The cost is low, but to some extent, in some other industries, the cost is also quite low. So if you actually let yourself produce a T-shirt somewhere, the cost for producing that T-shirt is low as well. But there is one more point to add why the industry is so profitable, and you said it more or less. There is a more technical term I'm after. So why actually, at least ultimately, is the industry so profitable? What's the technical term typically you need to apply, or which describes that best? Anyone with an idea? So at least the answer is a little bit multifold, but one of the answers is, in the technical term, is the industry is highly scalable. That means you not only have low costs, but your costs are more or less fixed. So you have one fixed cost block, and whenever your revenues are exceeding that cost block, everything else is profit. And why is that the case? So what do you need for index calculation? We will see in a minute, but you need a computer, more or less. That's it. And whenever you are then able to extract revenues, it doesn't matter so much ultimately how much people are going to pay you the revenues, because you need to calculate the index only once. And even if you want to calculate 3 million of indices, it's just calculation done by a computer. You need maybe a little bit more power, but it's not necessarily going to swing your cost base dramatically. Now, there is a different aspect to the topic as well, and that is it's to some extent a little bit of a monopoly or oligopoly, so to speak. The indices are brand protected. So you aren't allowed to use the brand of those indices. And if you at least have established a brand, it's very hard for anyone else to come into that industry and to ultimately take the business away from you. The Dow Jones Industrial Average is the Dow Jones Industrial Average. So there's no chance for anyone else ultimately to come up with the same index. It's just legally protected. So when you have established your business, the mold for anyone else to come in is extremely high. So the combination of these elements, having a kind of very scaling business model on the one side and having a very protected business model on the other side, makes the overall industry so profitable. And obviously, of course, as these people do want to earn more and more money, they just invent more and more indices, and in the end, they grow dramatically. All right, here we are going to make a quick break for 5 minutes, and then we are going to, and then I'm rushing you through index calculation, which isn't a big deal, but you will see in a second how easy in principle it is, and I'm going to explain it to you that by the end of today, you have a chance to do it by yourself. So let's come back in 5 minutes, please. All right. I said that I'm going to share with you a little bit about how many indices exist out there. And now let's do a little bit of the back of the envelope estimate, at least for a second. And then we get a better understanding how many of those indices are really available. Now, what do people do? They calculate indices for the entire market. So they just collect all the stocks in those different markets, and then actually they just add them up. And how they will do that, we will learn in a minute. But we know ultimately there are 192 countries out there in the world. Maybe sometimes a little bit more or less developed with their capital markets, but that is at least the first one. Then at least people ultimately say, yeah, see, there are certain smaller shares which are not so liquid. Let's exclude them and concentrate only on the more larger ones. Then you have at least two different alternatives. And then they say ultimately, yeah, even more exclude more of the small ones and concentrate on the very large ones only, or let's concentrate on the tech stocks only. And then you have already whatever 5 or 6 different indices for each different country out there. Now, then we have, of course, industry groups. It's not only the tech stocks, but you do have whatever the car makers and the oil producers and the utilities and so on. So you have, for each country, you do have whatever 20 different industry groups in addition. So you have 5 different variants, you have 20 industry groups, you have 200 countries. You may ultimately calculate your indices in different currencies, so in 10 different currencies. So you need to multiply that as well in there. Then you do have indices not only for stocks, but also for bonds, which enhances significantly the number of indices available out there. And then people invent more and more very specific indices, and we are going to look at one of them later on, as I initially introduced. That is the DAX ESG 50 indices, which are more or less identifying very specific strategies, or very specific, having a very specific focus. And that is then, of course, then leading at the end to this kind of enormous amount of indices. And of course, these index providers are highly innovative. When the corona pandemic started, people started to immediately create an index for all the companies benefiting from remote work from home. It's more sometimes investment strategies being mapped in those indices as well. Now the question is, are they important, those indices? Or all these 3 million. Now, obviously, when we go through our mind, our brain, and think about indices, we come to a handful only, to the 100 or maybe even less. And in terms of revenues, in terms of revenue generation, typically only very few of those indices contribute for the majority of revenue generation in general. And that is what I want to share here with you. For one of the large index providers, for Standard and Poor's, or for S&P, the S&P 500 contributes about 3/4 of the entire revenues being generated with. So they calculate 1 million of indices, but at least one of one index is calculating or contributing for about 3/4 of all the revenues. So it's a highly concentrated business and a highly concentrated industry. Now, how does index calculation work? And I have put together here a few formulas, and it may look a little bit confusing at the beginning, but we are going to concentrate on certain of these elements in this formula step by step. And the underlying idea is completely simple. Now, the underlying idea is the index just measures the performance of the underlying index portfolio. So think about the Dow Jones Industrial Average. It's 30 stocks, and the performance of or the weighted performance of those stocks is just the index value. Now, it's actually a bad example, and I've put in the exercise also something where you may play a little bit around with. The Dow Jones does not work exactly that way, and that has more historic reasons. It's a little bit of an artifact. But the other, typically all the other indices work in the way like I described it right now, and it is exactly the way that the index describes the change of the value of the underlying index portfolio. So when the stock prices rise, then at least the index goes up. Now, and the formulas may sometimes look a little bit different, but it hopefully gives you some understanding and idea when I'm going to run you through this specific formula here. And that is then going to give you a good understanding how does it work in general. Yeah, so you have a portfolio in the beginning of all these kind of different stocks, and this portfolio comes with two features. Yeah? So A, you need to know how many of those stocks are in that portfolio, and B, you need to know the price of those stocks. Yeah? And that is what your formula exactly tells you here. So there is a price, and when the price is going up, then of course ultimately the value of your portfolio goes up. Yeah? You just weight that. So that's number one. And number two, you need to know about the quantity of those stocks in your portfolio. And the quantity that requires a very brief explanation here. The quantity comes typically in a different fashion. So people do not take all the stocks available out there, but people take typically only the stocks which are available for trading. Yeah. So what does that mean? If there is an investor and this investor has acquired a quarter of the company, then typically it is assumed that that amount of shares, that quarter of shares, is not available for trading anymore. And that is why the number of shares is being reduced. So the free float, the available shares, is only the number of shares which is typically being used in this index portfolio. You only consider those shares which are freely available. If somebody has bought and acquired a significant share of that company, if he is a strategic long-term investor, then these kind of shares are being excluded. Now, this is the second thing in my formula which I need to clarify here. And then, of course, a couple of things may happen to my portfolio throughout time. And this is when I do need to make a certain adjustments. But with the underlying understanding about what the index portfolio is doing, we immediately can understand how our index calculation is being adjusted. So the first thing which may happen is a company ultimately may pay dividends. That's going to happen from time to time. Now, what does happen to my portfolio? If my portfolio, I have certain stocks in that portfolio, I will earn some cash in that portfolio. So if I'm an investor, I just get the dividends. Now, the index, of course, also replicates that. And then he is going to use that cash and immediately invests that cash again into stocks of that index portfolio. So dividend is being paid, and the index formula is then automatically adjusting that payment into acquiring, into purchasing just new shares. And that is typically being done by some correction factors in my formula. So I have in my formula, I have the price of my shares, I have the number of my shares in that formula. That is ultimately what I need. And then at least I also need to correct from time to time. For example, in case dividends are being paid. And if a dividend is being paid, then I just can use the cash of that dividend to purchase some more of the stocks in that portfolio. Yeah, that's how this correction factor does work. The same is true ultimately when we have a stock split. Yeah, sometimes stocks are being split into two. Yeah? So if the stock price was increasing over some time, then at least people say ultimately it's just too expensive for people to buy that stock. It's better that I ultimately now cut it in the middle and give everyone who currently holds a stock 2 of them. And then again, I'm going to correct for that. So the number of shares is then just being corrected in my index calculation, because my portfolio doesn't change. As the value of my portfolio doesn't change. It's only that the number of shares in my portfolio has changed. I have now twice the number of shares of one stock, but obviously the price of that share has reduced to a half. So many of the shares out there are being often split. And so all the events happening, all these kind of what is called corporate events or corporate actions on my stocks are being replicated in that formula. And I usually do that with some correction factors. Yeah? So the only remaining thing is that I do have to normalize a little bit my calculation in the end. And that is, I do need to have here some kind of base value at the bottom. And then I'm done with my index calculation. So my index calculation is very simple. I'm just taking the price of my shares in my index portfolio. I multiply it with the number, and then I do correct from time to time if something is happening. But the value of my index is always going to exactly replicate what's happening with the portfolio of my stocks I have in my index portfolio. So it's very simple. I just need to look to the value of that portfolio, and I exactly know whether the index will go up or down. Now, this is particularly important because at some point in time, we are coming from the other end. That's what we are going to do by next time. We want to replicate the index. Now, replicating the index is very simple if my index is nothing else than a portfolio of stocks, and just describing the value of that stocks. So this is more or less than being exactly the same. So index calculation may seem a little bit complicated, but as long as you have one thing in mind, that it is just nothing else but the value of the underlying index portfolio, you always can immediately rethink what you need to do in order to adjust your index formula properly. Yeah, and all these index formulas do nothing else than describing these features. Now, indices come in very different ways across. And we need to at least be very careful from time to time when looking at some of these things. Indices are sometimes price indices. That means they are not considering dividend payments at all. So if you look to an index, which is a price index, the dividends are not being reinvested into these stocks in the index portfolio. Sometimes indices consider the reinvestment into those stocks, and then the index is a total return index. So there are different variants existing, and that's then in particular important when you are going to invest into those indices. Yeah. Sometimes they are considering taxes. Sometimes they are not doing that. So there are a lot of very different details. But in essence, ultimately, the underlying idea is still the same. Yeah? It's the value of the index portfolio. Now, obviously, from time to time, I'm going to change constituents in my index. Yeah? So the Dow Jones Industrial Average holds now companies like Apple and Microsoft. Now, these companies have not been existing when the Dow Jones Industrial Average was initiated in 1896, very clearly. So it seems that from time to time, you need to take out an existing index company and replace it with a new one. Now, with the understanding what the index is doing and measuring, we immediately can describe clearly what our index formula need to do. Yeah? The index is describing the value of my index portfolio. Yeah? And if I'm going to replace one of these constituents, I, of course, take that portion of the portfolio out and buy for that portion of the portfolio the new stock which I'm going to include. Yeah? And this is a process which is happening regularly, once a year, once a quarter, depending a little bit on the index. But when that is happening, the overall value of my portfolio is not going to change. So the index is not going to change. The only thing which is going to change is the composition of my index portfolio. And I'm just going to take the value of one of those components and buy for that value a different stock. Yeah? So the index is not going to change. It's just the underlying index portfolio, which is going to change. And this is typically or formalistically being done by putting some kind of factor in front of my index calculation. Yeah. So now, ideally, you have understood most of the elements of the formula. It's very simple. It's the weighted price of the different index constituents, sometimes corrected. It's normalized that my index is going to start with 100 or 1,000 at some point in time. And from time to time, I'm adjusting the constituents, and that's why I have this connecting factor in front of my formula. This is how index calculation works. So you don't need to know anything more about that. So it is as simple as that. It just measures the value of the corresponding index portfolio. And now, when we want to calculate a new index, now we think about a kind of great new index we want to have, we want to create now by ourselves. We have learned it's kind of great industry, high profit margins. So let's get started. The first thing we need to do is we need to define the index universe, so to speak. So the area where I'm going to construct my index for, say it's Europe or it's the US or it's Germany. That's my underlying index universe. And then I do need to come up with certain rules and with certain rules in order to select the companies I want to include into my index. Yeah? So that's the first step I need to, that's the second step after defining the index universe. Yeah? So if I'm going to invest into Germany, if I'm going to invest into the DAX 40 now, I need to create some rules that how to identify the 40 companies I want to include into my index. Maybe my companies should be all very large or should all whatever have some other features. That's what I need to do then next. I need to define these selection rules. And then I do need to define how I'm going to weight my different companies in my index. So whether I'm going to say, I just buy one share of each, or whether I'm going to say I buy as many shares that I'm matching the market capitalization of those companies very closely. Yeah? This is then what I'm going to do next. Yeah? So I define my universe, I define my selection criteria, I define my weighting, and then I'm more or less done. The last step is then I need to correct for the corporate actions. I do need to make up my mind whether I consider dividend payments or not. Yeah? But that is index calculation on one page, so to speak. Yeah? So you just measure the value of that index portfolio in the end, whether the value is going up or down. That's what your formula is doing, and how to end up at the index portfolio. You start with the index universe, you start with selecting certain companies, you start with weighting those companies, and then at least you apply certain corporate actions. Are there any questions? Because if there are no questions, there's a yeah. As I said, ultimately, typically indices are market capitalization weighted. Now that's very simple. And you do not, at least in theory, you do not need to adjust weights at any point in time. Because very simple, market capitalization weighting does mean you just take the number of shares of that specific company in your index portfolio, how many shares they have issued, and then at least the weighting comes into play by, if the price is rising, of course, the weight of your company is going to increase. So you fix more or less, the weighting is defined by the market capitalization of the company. And that is what is most widespread in index calculation. And then there's no need to adjust the weightings at any point in time in the future, at least in theory. So some of the kind of more, there are many more specific details you may want to consider, but at least in theory, there is no further need to adjust weights anymore. So if the price of Apple is going up, then of course Apple has a higher market capitalization, but of course, as the weighting in your index, or the weight in your index portfolio is the number of Apple shares times the price, the market cap is going to go up. In your index portfolio, it's always the market cap, it's the aggregated sum of all the market cap of the different companies. Now let's look to a very specific example, and let's apply what we know. And I'm going to get started here with a historic chart, and we see, what do we see? We see it looks very, very similar. And I share here with you the DAX ESG 50, that's the green line. And I compare that with the DAX, and I compare that with the CDAX. The CDAX is actually the collection of all the larger shares in Germany in total. And what we see is that the DAX ESG 50, at least for some of the periods we consider here, seem to be better than the DAX. That's what the figures suggest here. So the performance is a little bit larger. But if I compare that not to the DAX, but to the CDAX, I see it's not necessarily larger. I also do see something which is a little bit more, and I see, and we will define a little bit later, also some kind of key ratios which help us to understand what is a better investment. So somebody invests into Apple, and somebody invests into Microsoft, and somebody invests into Tesla, but what is the better investment? Now, in order to come up here with a unique answer, we are going to define at some point in time these key ratios, and they give us then a kind of answer. They rank for us what the better investment is. These key ratios are, for example, the Sharpe ratio or the information ratio. And it seemed to some extent that when I'm going to look at some of those key ratios, again, ultimately the DAX ESG 50 is a little bit better than the DAX, but it's not better than the CDAX, and it's at least worse compared to the DAX if I'm going to use a different ratio here. Now that starts to make me a little bit puzzled, and now let's look into what I've shown you before. Yeah? And with all the knowledge about index construction, we now exactly know or can analyze that index a little bit more deeply. So what does that index do? Now, at least it suggests that it is going to invest into ESG. So the DAX is the collection of the 40 largest stocks here in Germany, and the DAX ESG 50. What is that? At least it's not the 40 largest stocks, but it is something different. It starts with the index universe, and the index universe is a little bit differently defined compared to the DAX. And then at least they apply not only the kind of selection criteria for the DAX, but they apply some other criteria as well. And these are the criteria we are going to look into much more detail throughout this course when we are concentrating more on ESG investing. The criteria here are, they are concentrating on some, they exclude something, they exclude certain companies, and then they at least also require some ESG scores to be considered for this selection. It's not entirely clear, or one may dig a little bit into that in a minute, but the rest seems pretty similar. So the only thing which is different is they're going to select a couple of different companies out there. They weight them pretty similarly, and then in the end, they also do the corporate action adjustments in pretty much the same way. But now let's have one look deeper into that. And when we are now going to look into, and hopefully you can read that to some extent, when we are now going to look into the detailed index portfolio of that index, and compared with the DAX, we do observe a few things. So first, overall, the composition seems to be rather similar. So there is not too much of a difference. A few companies, at least, have not made it into the DAX ESG 50, which we do find in the DAX. Now, Airbus is in the DAX. One may question whether Airbus is in the DAX anyhow. Airbus is producing planes, is producing as a French company. So primarily, it's located somewhere in Toulouse. Why that actually is a company which is in the DAX is a very interesting question. And we may discuss that at some point in time, but at least it's a French company. It's not in the DAX ESG 50, primarily also for the reason because it's going to produce nuclear weapons. So that is at least something we do understand. And then at least also RWE is not in the DAX ESG 50. And we had a discussion about RWE a little bit earlier, but E.ON is also not in the DAX ESG 50. Now that is at least going to make us a little bit wondering. And when we are going to look into ESG scores in more detail, we will learn more about that. But E.ON is at least only providing services for power distribution and not necessarily producing electricity anymore. So this is something they have given up. So at least from that point of view, it's not necessarily a reason to exclude E.ON. But we do find a couple of different companies, at least in the DAX ESG 50. We do find Lufthansa in the DAX ESG 50. So we have an index on concentrating on ecological and social and governance aspects. And we do find in that index an airline. And a good question, of course, is that at least what we are going to expect from such an index? Very simply speaking, airlines are not necessarily the best for our global climate. And then it becomes a little bit more worrying anyhow. Heidelberg Cement, it's company headquartered close by, It's one of the largest cement producers worldwide. Now, and if I'm going to read that the cement industry is one of the main producers of carbon dioxide worldwide, then of course I start wondering a little bit why at least Heidelberg Cement forms part of the DAX ESG 50. So what we have on the one side is we do have an index that comes across with a kind of very compelling and a very, very strong marketing argument, because it makes you understand, or it makes at least believe, that it is going to focus and to concentrate on sustainable aspects. And on the other side, part of that index does form companies which potentially do not necessarily are the ones you would expect to be included there. Now, the underlying reason is the famous ESG score, which is being assigned by some kind of company. So obviously we need to learn a little bit more about these ESG scores and how that works. And that is what we're also going to do a little bit later. But the answer is, with your knowledge about how index construction does work, if you would buy the DAX ESG 50, you now can at least understand how it is being constructed, how it's being set up. And we are able to look now into more details and hopefully unveil a little bit more the secret, how those less sustainable companies at some point in time also makes it into these indices. So this is what I intended to do by today, giving you also one very concrete example about a sustainable index, where we do find out, if we are looking a little bit under the hood and into the details of construction, we at least spot certain things which start to make us feel a little bit more puzzled, and where we are going to have then where it requires us to look into more details, which we are going to do later in this course. You should have been able to take away from today a few things on index construction in general, or on indices in general. So you should understand that there are millions of indices existing, and likely for every purpose you have in mind, you do find an index if you search for long enough. That's number one. So the industry is highly profitable. It's very concentrated. It's very dominated by a few players. Keep in mind what the index is. The index measures the performance of the underlying index portfolio. So I have a portfolio of companies which are forming my index. And if the value of that portfolio is going up or down, the value of my index is going up or down. And if something is being changed in that portfolio, company is being put out, dividends are paid, something like that, it's just being reflected in the index. Because the value must be the same. This is what you need to understand about indices. And then there is the kind of typical approach towards calculation. You start with some kind of universe, some area you want to invest into. You extract out of that universe a few companies, you select them according to some criteria. You are weighting them accordingly, and then in the end you have your index portfolio. And obviously some of the ESG indices are not so much different from the original index, and I haven't said that, but the weight of the top 20 constituents makes up 80% of the index, and it's pretty much the same for both of those indices. So whether you buy one or the other doesn't make a lot of difference. The total weight of the top 20 constituents already ultimately accounts for 80%. The difference is minor, but when you look then into certain details, we found out that at least some of the things we have spotted in the ESG variant, we wouldn't have expected there. So this is what I intended to share with you by today. Any questions? All right, there is one thing to mention. Yeah. For some reason, we had to find out that it is not possible for all to participate in presence for the final exam. That's a little bit unfortunate. And we learned, at least out of that we need to make it clear next time that the setting is the setting, and that we need to stick to the setting, and that we need to communicate the setting already in advance properly. We are going for that reason to make an online exam, which is not necessarily the kind of preferred way how to do the exam, because then we do have, of course, the understanding that it's more an open book exam and all the kind of things. Well, finally, my intent is that you should be interested in the subject anyhow, unless ultimately my intent is not necessarily, or my interest is not necessarily to make here an exam anyhow, but you should more have fun and interest for the subject. But for anyone, or to make it clear, we are going to run in the end at the set date an online exam. So there is a specific point in time when the exam is going to happen. That's announced, and that should also be in the relevant portals available and highlighted. At that point in time, the online exam is going to happen. We are going to make a tech mock-up in advance that you can try it out. The technology is working properly, but at that point in time when the exam date is announced, the exam will happen as an online exam. Any further questions? Yes, please. My understanding is it's an online exam from wherever you are going to log in. We don't care. Obviously, we have the interest that you're not going to log in as a big group doing all these things jointly, but I have some good understanding how it's working. Good. Anything else? There is an Excel sheet and it provides you answers as well. Yeah. So I've uploaded also some other exercises. I'm not so sure whether they create a lot of interest, but at least for the first set of exercises, the solutions are uploaded. And for the ones being interested in some other stuff, I've uploaded some other exercises in addition. They should be it's all available in the portal. And I also uploaded the Descriptor report, at least the abridged version, for the ones being interested. Anything else I can do for you, rather than stopping and letting you rush for lunch? Can you please repeat that? So at the end, at the end of the lecture notes, there are questions. These are self-review questions. I'm very happy to help everyone individually if there are questions existing, but my intent here is we're not in school anymore. Yeah? I intend you to help to go through these questions to deepen a little bit your understanding. I'm not going to review those questions in detail. I'm neither here in the lectures, nor I'm going to provide you answers. The answers are more or less consistently coming out of the other material which I have uploaded. If something ultimately stays unclear, you of course always should feel free to approach me. Yeah? Drop me an email, approach me here, that's all great. But these things are more designed for self-studying. So, anyone else still not hungry and wants to ask a question? Good. Thanks a lot very much. Enjoy your week, stay healthy, and looking forward to see you next week. Bye-bye.